You walk into a glass building, shake hands with a man wearing a bespoke suit, and you hand him your life savings because you believe the most asinine lie ever sold to the American public, that complexity implies intelligence. You have been brainwashed by a massive, self-perpetuating industry to believe that managing money is akin to brain surgery, requiring a specialist with a secret decoder ring to navigate the markets for you. It is absolute twaddle. The financial services industry is largely a croupier class, a massive engine designed to transfer wealth from the patient to the active and from the client to the broker. They sell you diversification because it covers their behinds, not because it makes you rich. They sell you activity because activity generates fees. They sell you the idea that they can predict the future, which is a folly so grand it borders on psychosis. If you look at the incentives, and as I have said at the 1995 Harvard talk, incentives are the superpower of the human mind, you will see that your financial advisor is incentivized to make things complicated. If they told you the truth, which is to buy a low-cost index fund, sit on your ass for 50 years, they would be out of a job. They are selling you a feeling of safety, but it is the safety of a sheep being sheared by a very polite barber. The sheer arrogance of the modern financial complex is a lollapalooza of human misjudgment. You see these people on television, the talking heads, chattering about interest rate hikes and quarterly earnings misses as if any of it matters to the long-term owner of a business. It is noise. It is rat poison. And you, the fool, you lap it up because you have been trained to think that doing something is better than doing nothing. In almost every other field of human endeavor, effort correlates with output. If you run harder, you get faster. If you study longer, you get smarter. But in investing, this is inverted. The more you move, the more you pay, and the less you keep. The market does not care about your effort. It does not care about your advisor's prestigious degree. It cares about the underlying economics of the business you own. When you pay a manager 1% or 2% of your assets per year, you are not paying for performance. You are paying for a soothing voice to hold your hand while they slowly bleed your compounding potential dry. Over 30 years, that 2% fee doesn't just take 2% of your money. It devours nearly 40% of your end capital. It is mathematical murder. I am not your advisor. But if I were, I would tell you to consider treating the financial news cycle like a sewage pipe, something to be avoided at all costs, lest you get covered in filth. The most dangerous thing an investor can do is interrupt the compounding process due to a temporary emotional reaction to a headline. This is where the helpers get you. They call you with a new strategy or a rebalancing opportunity. It is nonsense. It is a way for them to justify their existence. You must understand that Wall Street is not there to serve you. It is there to service you in the agricultural sense of the word. They are extracting rents on capital they did not earn, managing risks they do not understand, and selling products that are often little more than toxic waste wrapped in a pretty bow. The derivative markets, the cryptocurrencies, the complex hedge fund strategies, it is mostly just gambling with better marketing. It attracts the kind of people who would rather be clever than rich. I have always preferred to be rich. Let me tell you about a mistake I made, a personal failure of rationality that haunts me more than any missed stock pick. It was 1962. I was arrogant, young, and thought I could fix a broken business through sheer force of will. I bought into a farm equipment manufacturer thinking I was getting a bonanza because the price was below book value. It was a classic cigar butt investment, cheap, ugly, and with one puff left in it. I put roughly 100 zalozin into it. In today's money, that is a fortune. I spent years agonizing over labor disputes, inventory rust, and a dying business model. I eventually got my money back with a small profit, but the opportunity cost was staggering. If I had taken that same 100 zalozin and put it into a high-quality business with a durable competitive advantage and just sat on my hands, it would be worth hundreds of millions today. I lost a fortune not because I lost capital, but because I wasted time. I tried to be smart. I tried to be active. I ignored the fundamental truth that it is better to buy a wonderful business at a fair price than a fair business at a wonderful price. I was operating like a modern fool looking for a quick arbitrage when I should have been looking for a partner. Contrast the frenetic stupidity of the modern-day trader or the mutual fund manager with the titans of the old world. Look at John D. Rockefeller. Look at Andrew Carnegie. Look at the early days of Berkshire Hathaway under the Standard Doctrine. Did Rockefeller have a diversified portfolio of 500 stocks he knew nothing about? No. He owned Standard Oil. He knew every barrel, every refinery, every railroad rebate. He concentrated his capital where he had the highest conviction and the deepest understanding. He didn't wake up every morning and ask a 25-year-old broker, What should I do today, John? He knew what to do. He ruthlessly eliminated competition, optimized efficiency, and held on for dear life. The modern diversification dogma. This idea that you must own a little bit of everything to be safe is a confession of ignorance. It is an admission that you do not know what you are doing, so you will do a little bit of everything and hope the average works out. For the know-nothing investor, indexing is the perfect solution. But for the professional who claims to offer value, it is a shield for incompetence. The greats operated with a mindset of ownership, not speculation. When we buy a stock at Berkshire, we are buying a piece of a business. We are not buying a squiggly line on a chart. We are buying the cash flows, the management, the brand, and the future of that enterprise. We check the price perhaps once when we buy it, and then we barely look at it again. Modern fools check their portfolios 10 times a day on their phones. This is a sickness. It triggers the dopamine receptors of a gambling addict. Every time you check the price, you are inviting the devil of emotional misjudgment into your house. You are inviting envy, fear, and greed to sit at your dinner table. The old industrialists understood patience. They understood that building wealth takes decades, not quarters. They didn't care if the stock market was closed for 5 years. Today, if the market dips for 5 minutes, people lose their minds. This lack of temperament is why the transfer of wealth from the impatient to the patient is inevitable. To understand how to win, you must first master the art of inversion. This is a mental model I learned from the great mathematician Carl Jacobi. Invert. Always invert. Instead of asking, how do I get rich? You must ask, what will guarantee I stay poor? It is a much easier question to answer, and the answers are illuminating. If you want to guarantee poverty, you should do the following: spend more than you earn, borrow money at high interest rates to buy depreciating assets, trade stocks frequently based on tips from taxi drivers or television personalities, and pay high fees to consultants who add no value. If you avoid these things, you are already ahead of 90% of the population. It is not brilliance that makes you wealthy. It is the avoidance of stupidity. We have made billions at Berkshire not by being smarter than everyone else, but by being consistently less stupid over a longer period of time. We avoid the too hard pile. We avoid businesses we don't understand. We avoid people we don't trust. Most people cannot handle the simplicity of inversion because it requires humility. It requires you to admit that you are not a genius, that you cannot predict the future, and that you are prone to psychological biases. The financial industry preys on your lack of humility. They stroke your ego. They tell you that you deserve exclusive access to private equity deals or complex derivatives. They are selling you status, and status is a very expensive commodity. When you invert the problem, you realize that the best investment strategy is boring. It is lethargic. It borders on sloth. You find a great business, you buy it, and then you enter a coma. That is the secret, but you cannot charge a 2% management fee for telling a client to enter a coma. So the advisors invent activity. They invent tactical asset allocation. They invent sector rotation. It is all noise designed to separate you from your money. Let us look deeper into the too hard pile, a concept we discuss often at the daily journal meetings. Inversion teaches us to define our circle of competence and stay strictly within it. The modern fool believes he must have an opinion on everything. He reads a headline about artificial intelligence and suddenly believes he is an expert on semiconductors. He reads a tweet about electric vehicles and decides he understands the supply chain of lithium. This is delusional. I have 3 baskets on my desk, in, out, and too hard. The too hard basket is overflowing. The in basket has very few things in it. By forcing yourself to say no to 999% of opportunities, you protect yourself from the disaster of ignorance. The financial advisor, however, wants you to say yes. They want you to be in the latest trend. They want you to buy the IPO. They want you to churn. The 3 decisions you must master are these: first, the decision to do nothing, which is the default state of the wise; second, the decision to say no immediately to anything you do not understand or that smells of fraud; and third, the decision to bet heavily when the odds are overwhelmingly in your favor. That third decision comes along rarely, maybe a few times in a lifetime. When it does, you must have the courage and the capital to act. But you will not have the capital if you have frittered it away on fees and foolish speculations. You will not have the courage if you have been conditioned by an advisor to diversify away all your conviction. You must unlearn the habits of the crowd. The crowd is a maniac. The crowd is driven by envy and fear. If you follow the crowd, you will get the crowd's results, which are mediocre at best and disastrous at worst. Inversion also applies to your own temperament. Ask yourself, what psychological flaws do I have that will destroy my wealth? Are you impulsive? Do you need validation from others? Do you suffer from envy? Envy is the stupidest of the 7 deadly sins because it is the only one you don't even get to have any fun doing. If you are envious of your neighbor who made money in Bitcoin, you are setting yourself up for a fall. You must root out these traits with the ruthlessness of a surgeon removing a tumor. The market is a mechanism for discovering your flaws and punishing you for them. If you do not understand who you are, the market is an expensive place to find out. The helpers on Wall Street know this. They exploit your fear of missing out. They exploit your greed. They are not your friends. They are the counterparty to your financial well-being. Finally, consider the concept of avoidance in the context of debt. If you invert the path to freedom, the surest path to slavery is debt. The modern world is awash in it. Governments, corporations, individuals, everyone is leveraging up to buy things they don't need. It is a form of madness. If you are smart, you don't need debt. If you are dumb, you shouldn't use it. It is that simple. Yet, advisors will tell you about good debt and leverage strategies. They are handing a loaded gun to a child. I have seen more smart people ruined by leverage than by any other factor. It creates a fragility in your life that is unacceptable. You must avoid it like the plague. Live within your means. Save your capital. Wait for the fat pitch. And when the rest of the world is crying and selling because they are over leveraged and panicked, that is when you step in. That is when you strike. But you cannot do that if you are listening to the siren song of the easy money fools. You must be a rock in a sea of madness. Most people treat time as if it were infinite, spending their days in a haze of triviality and distraction, unaware that the sand in the hourglass is not just slipping away. It is accelerating. You must understand the brutal mathematics of your own existence. If you are 40 years old, you do not have 40 years of investment decisions left. You have perhaps 20 meaningful years of high cognitive function where you can compound capital before the inevitable decline of your faculties sets in. Every specific decision you make to hold a mediocre asset is a direct theft from your future self. It is a crime you commit against your own potential. The financial advisor industry is complicit in this crime because they sell you the illusion that you can afford to be average. They put you in a balanced portfolio of 60% equities and 40% bonds, ensuring that your returns will be pulled down by the gravity of mediocrity. They tell you that time in the market is the magic elixir, but they fail to mention that time in an F-bad investment is simply a prolonged period of suffering. Time is a decaying asset. It is the only asset you cannot buy, you cannot hedge, and you cannot short. To waste it on a stock that is merely okay or a fund that tracks a bloated index is not just a financial error. It is a moral failing. The concept of opportunity cost is the most important filter in the human mind, yet it is almost entirely absent from the vocabulary of the standard wealth manager. They look at an investment in isolation. They ask, is this a good company? That is the wrong question. The right question, the only question that matters is this the single best use of my capital right now compared to everything else available to me? If you have a business that generates a 20% return on capital with certainty, and your advisor suggests you put money into a bond yielding 4% because of diversification, you should fire him on the spot. You are trading a diamond for a handful of gravel. At Berkshire, we measure everything against our best idea. If we have a holding that we know will compound at 15%, we do not look at anything that yields less than that. We simply discard it. The world is full of mediocre opportunities. They are like weeds. They grow everywhere. If you let your portfolio fill up with weeds because you are too lazy to wait for the flower, you deserve the jungle of mediocrity you will undoubtedly end up with. You must be ruthless. If an idea is not better than your current best idea, it is a distraction. It is noise. It must be destroyed. This brings us to the algebra of the fat pitch. I have often referenced the great baseball player Ted Williams, who wrote a book called The Science of Hitting. He carved the strike zone into 77 distinct cells, each the size of a baseball. He knew that if he swung at a ball in his sweet spot, he would bat 400. If he swung at a ball on the lower outside corner, he would bat 230. In baseball, if you don't swing at a strike, the umpire calls a strike and eventually you are out. But the stock market is a unique game. It is a no-called strike game. You can stand at the plate, bat on your shoulder for days, months, or even years. The market can throw you General Motors at 40, and you can stand there. It can throw you U.S. Steel at 30, and you can stand there. You don't have to swing. You can wait for the pitcher to lose his mind, or for the crowd to panic, and for the market to throw you a fat pitch. A wonderful business at a distressed price right down the middle. And when that happens, you don't just swing. You swing with every ounce of strength you possess. You try to hit the ball out of the stadium. The problem with the modern financial advisor is that he gets paid to make you swing. He gets paid on activity. If you sit in his office and say, I am going to hold cash for 3 years until the market crashes, he will look at you like you have two heads. He will tell you about cash drag. He will show you charts of missed market rallies. He is incentivized to keep you fully invested in his fee generating products at all times. This is why the average investor underperforms the market index by such a wide margin. They are swinging at bad pitches. They are swinging at pitches in the dirt because they are afraid of looking inactive. You must have the discipline to do nothing. I have said it before, it takes character to sit with all that cash and do nothing. It takes a certain kind of arrogance to ignore the chatter of the crowd, but that arrogance must be earned through study. You cannot just sit there and be stupid. You must sit there and be ready. You must be like a coiled spring, waiting for the tension to release. When the opportunity comes, you must move with violence and speed. Let me tell you about a mistake that still makes me wince when I think about it. It was 1979. The company was Belridge Oil. This was a clear, obvious Lollapalooza of an opportunity. The company owned massive oil reserves in Bakersfield, California. It was a simple business. The oil was in the ground. The price of oil was going up. The management was competent. It was trading at a price that was ludicrously low compared to the proven reserves they sat on. It wasn't a speculation. It was a vault of gold with the door left open. I saw it. I understood it. I knew the math. I bought a few hundred shares. I think I put in something like $1 million, maybe a bit less. Now, you might say, Charlie, that sounds like a good trade. And it was. The stock shot up. Shell Oil came in and bought the company for $3.6 billion shortly after. It was the biggest takeover in history at the time. My little investment turned into a massive windfall. But here is the tragedy. I should have bought everything. I should have sold the house. I should have borrowed money. I should have scraped every penny I could find and put it into Belridge Oil. I had the capital to buy much, much more. I could have bought 30 million worth. I could have owned a significant percentage of the company. But I didn't. Why? Because I was trying to be too cute. I was trying to buy it a little cheaper. I was looking at the price and thinking, well, maybe it will come down a bit more. I was penny wise and pound foolish. I let a trivial difference in price prevent me from making a monumental difference in outcome. The consequence of that mistake is not measured in the money I lost because I didn't lose money. It is measured in the billions of dollars I did not make. That is the true definition of opportunity cost. It is the ghost of the wealth you could have had if you had just been rational enough to seize the moment. The lesson from Belridge is that when the odds are overwhelmingly in your favor, you must bet heavily. The diversification crowd will tell you this is dangerous. They will tell you that putting 20% or 30% or 50% of your net worth into one stock is reckless. I tell you that keeping your money in 50 stocks you don't understand is reckless. If you find a Belridge Oil, a situation where the downside is protected by hard assets and the upside is virtually unlimited due to market stupidity, and you put 2% of your portfolio into it, you are not being prudent. You are being a coward. You are letting your fear of being wrong outweigh your rational assessment of the facts. The market does not give you many of these chances. You might get 5 or 6 in a lifetime if you are lucky. To miss one because you were asleep is forgivable. To miss one because you were distracted is unfortunate. But to see one, to understand it, and then to bet small, that is a sin. It is a sin against the God of compound interest. You see, the algebra of opportunity is non-linear. One great decision can carry a lifetime of mediocrity. If you had bought Berkshire Hathaway in the early days and held it, you wouldn't have needed to be smart about anything else for the rest of your life. You could have been a complete idiot in every other aspect of your existence and still died a billionaire. This is what the helpers don't want you to know. They want you to believe that wealth is the result of 1,000 small, clever decisions made every day. That keeps you dependent on them. The truth is that wealth is the result of a few massive, correct decisions made over a lifetime, combined with the extreme patience to let them work. It is about identifying the fat pitch, and then having the temperament to swing hard. Most people are incapable of this because they are wired to seek social proof. They want to do what everyone else is doing. If everyone else is buying tech stocks, they buy tech stocks. If everyone else is buying real estate, they buy real estate. They are lemmings. And like lemmings, their destiny is the cliff. To operate the way I am describing requires you to be comfortable standing alone. You must be comfortable looking wrong for a long time. When I was buying Belridge, nobody was talking about it at the cocktail parties. It wasn't sexy. It was an oil company in California. But facts are stubborn things. The value was there. The crowd was wrong. The crowd is almost always wrong at the extremes. They are wrong at the top when greed blinds them, and they are wrong at the bottom when fear paralyzes them. Your job is to stand apart, look at the arithmetic, and act when the discrepancy between price and value is so large that you cannot lose. But you have to act fast. The window of opportunity does not stay open forever. In the case of Belridge, the acquisition happened quickly. If I had waited another 6 months to make up my mind, the game would have been over. Time is the enemy of the procrastinator. In investing, hesitation is usually fatal. You must do your work early. You must read the annual reports. You must understand the business. You must have your buy list ready in your head. And when the price hits your target, you do not call your advisor to ask for permission. You do not wait for a committee meeting. You strike with conviction. This is the difference between the amateur and the professional. The amateur reacts. The professional prepares. So look at your portfolio today. Look at the clutter. Look at the mutual funds with high expense ratios. Look at the stocks you bought because your brother-in-law mentioned them at a barbecue. Look at the bonds that are losing value in real terms every day due to inflation. This is the debris of a wasted financial life. You are bleeding opportunity cost. Every dollar trapped in a bad idea is a dollar that cannot be deployed into a great idea. You must clean house. You must invert the situation. Instead of asking, what should I buy? Ask, what should I sell? Sell the mistakes, sell the mediocrity, raise cash, clear your mind, and wait for the fat pitch. Wait for the moment when the market offers you $1 for 50 cents. It will happen. It always happens. Human nature does not change. There will be panics. There will be crashes. There will be stupidity. And when it comes, do not be like me with Belridge Owl. Do not be timid. Be aggressive. Be rational. And for God's sake, don't ask a financial advisor what to do. They'll just tell you to diversify. There is a story about Max Planck, the Nobel Prize winning physicist, that perfectly encapsulates the fraudulence of the modern financial commentary class. After he won the Nobel Prize, Planck went around Germany giving the same lecture on quantum mechanics. Over time, his chauffeur memorized the lecture and said, Professor Planck, it must be boring given the same speech every time. How about I give it in Munich and you sit in the front row wearing my chauffeur's cap? Planck agreed. The chauffeur gave the lecture perfectly. He didn't miss a word. But at the end, a physics professor stood up and asked a devastatingly complex question. The chauffeur, without missing a beat, said, I am surprised to hear such an elementary question in an advanced city like Munich. I will let my chauffeur answer it. This is the distinction between Planck knowledge and chauffeur knowledge. Planck knowledge is earned. It is deep. It understands the underlying physics of reality. Chauffeur knowledge is mimicry. It is the ability to pronounce the words without understanding the music. When you turn on the television and see a man in a shiny suit screaming about a stock chart, or when you scroll through your phone and see a 20-year-old influencer telling you which cryptocurrency will go to the moon, you are looking at chauffeurs. They have the vocabulary. They say EBITDA, moving averages, and supply chain constraints. They sound authoritative. They sound confident, but they are empty suits. They do not know the business. They do not know the management. They do not know the competitive dynamics. They only know how to perform the role of an expert. This is dangerous because the human brain is wired to respect confidence. We are social animals, and we look for leaders. But in the financial markets, following a confident chauffeur is a suicide pact. These people are not paid to be right. They are paid to be entertaining. They are paid to keep your eyeballs glued to the screen so they can sell you advertisements for erectile dysfunction pills and gold coins. If you base your financial future on the advice of people who are paid to fill airtime, you deserve the poverty that is coming to you. You must learn to ignore the noise. You must learn to distinguish between the signal of a true expert who usually speaks with hesitation and nuance, and the noise of a charlatan who speaks with absolute certainty. The antidote to chauffeur knowledge is the circle of competence. This is a concept we hold sacred at Berkshire. You do not have to be an expert on every company in the S&P 500. You do not have to understand biotechnology and software and retail and oil. You only have to understand what you understand. If you know the insurance business cold, stay in insurance. If you know the grocery business, stay in grocery. The size of the circle is not important. Knowing its boundaries is vital. If you step outside your circle of competence, even by an inch, you are gambling. You are a patsy at the poker table. The financial industry wants you to step out of your circle. They want you to feel inadequate for not owning the latest tech darling. They want you to feel FOMO, Fear of missing out. FOMO is just another word for envy, and as I have said, envy is the silliest of sins. It is the only sin you can never have any fun at. Why would you buy a pharmaceutical company if you cannot read a clinical trial report? Why would you buy a bank if you cannot analyze a balance sheet? It is insanity. Yet, millions of people do it every day because a chafir on television told them to. You must have the intellectual honesty to look in the mirror and say, I do not understand this. That sentence is a superpower. It saves you from ruin. At Berkshire, we have a box on our desk marked too hard. It is the most important box we have. We throw 99% of the ideas we see into that box. We wait for the one idea that is inside our circle, easy to understand and priced so low that a moron could make money on it. That is how you get rich. Not by being brilliant, but by consistently avoiding stupidity. This brings us to the issue of trust and the people you allow into your life. You cannot make a good deal with a bad person. It is impossible. If the management of a company has a reputation for being slippery, for hiding the truth, or for enriching themselves at the expense of shareholders, run away. Do not look at the price. Do not look at the earnings. Just run. Character is destiny. This applies to your financial advisor as well. If your advisor is pushing products with high commissions, he is a bad person. He is stealing from you. It may be legal theft, but it is theft nonetheless. You must purge these people from your life. The financial world is full of sharks swimming in suits. They rely on your politeness. They rely on the fact that you don't want to make a scene. Make a scene. Fire them. Protect your capital with the ferocity of a mother bear protecting her cubs. To navigate this treacherous landscape, you must internalize a simple code of conduct, a set of iron laws that will guide you when the fog of panic sets in. I have boiled down 99 years of experience into the 3 decisions that will determine the trajectory of your life. These are not suggestions, they are mandates for the rational mind. You must make these decisions every single day, live below your means, never interrupt, compound, and remove toxic people. If you live below your means, you have freedom. If you spend everything, you are a slave to your wage. If you never interrupt compounding, you harness the most powerful force in the universe. If you trade in and out, you kill the goose that lays the golden eggs. And if you remove toxic people, be they dishonest brokers, envious friends, or spendthrift spouses, you remove the friction that slows your progress. You cannot soar with eagles if you are pecking around in the dirt with turkeys. Most people fail at live below your means because they are trying to impress people they don't even like. They buy the big house, the luxury car, the fancy watch. They are on a hedonic treadmill, running faster and faster just to stay in the same place. It is a miserable way to live. I still live in the same house I bought decades ago. It is a perfectly good house. Why would I need a bigger one? To show off. To whom? The neighbors. I don't care about the neighbors. When you stop caring about what other people think, you free up an enormous amount of energy and capital. You can direct that capital into assets that grow. You can direct that energy into learning. Wealth is not about having things. It is about having options. It is about the independence to wake up in the morning and say, I will do what I want today. That is the only luxury that matters. Never interrupt compounding is the hardest rule to follow because it requires an action. The world screams at you to act. The market drops 20% and your brain screams, sell. The market rallies 20% and your brain screams, buy. You must override this biology. You must be stoic. When you interrupt compounding, you are not just resetting the clock. You are destroying the exponential curve. The magic of compounding happens at the end, not the beginning. It is like a snowball rolling down a hill. At first, it is small. It takes a long time to get big, but if you stop it halfway down the hill to check if it's still snow, you destroy the momentum. You must let it roll. You must let it roll for decades. This requires a temperament that is rare. It requires the ability to suffer through periods of underperformance without losing your conviction. Remove toxic people is perhaps the most critical of the 3 decisions because toxic people infect your judgment. If you surround yourself with gamblers, you will become a gambler. If you surround yourself with pessimists, you will become a pessimist. If you surround yourself with people who view debt as a tool rather than a shackle, you will eventually find yourself in chains. You must ruthlessly curate your environment. Look at the 5 people you spend the most time with. If they are not rational, if they are not disciplined, if they are not honest, get rid of them. It sounds harsh. It is harsh, but life is short, and you do not have time to drag dead weight up the mountain of success. You need allies who understand the long game. You need people who will tell you when you are being an idiot, not people who will cheer you on as you drive off a cliff. Now, I want to address a comment from the previous video. Retired teacher 47, you wrote, I just buy the S&P 500 index and ignore everything else. I don't trust any of these guys. You're retired teacher 47, you are halfway to wisdom, which is better than most, but you are still in danger. You are right to distrust the helpers. You are right that the index is the best solution for the nothing investor. It beats 90% of the professionals. However, you must refine your thinking. Buying the index is not a strategy if you cannot hold it. When the S&P 500 drops 5%, and it will, mark my words, it will happen again, will you still ignore everything else? Or will you panic? The index is only safe if your temperament is iron. If you sell at the bottom because the television told you the world is ending, the index will not save you. You must combine your passive strategy with active psychological defense. You must be prepared for the pain. If you can do that, you will win. If you cannot, you will be just another victim of your own biology.